Hey everyone, welcome again to another episode of the Two Idiots podcast. As usual, this is your host Ravi here. On the other side is my wonderful co-host Ruben. Ruben, how are you?
Hello. Hi. Yeah, I'm fine. How are you?
I'm doing good.
Yeah.
It's a late recording session today. It's very late in the night.
We also did a homework, right? So to give our viewers the best possible content.
Exactly.
Yeah.
It's always we want to put forward the best content possible for our wonderful listeners. Yeah. So Ruben, what are we going to talk about today? Do you want to start us off?
Right. So recently the stock market is crashing really hard. And then if you look into the rebound actually leaves out the losers behind. So then if you try to understand who are these losers, these companies are the one that got good revenue growth, but they have negative net income, no free cash flow. So basically they are the business that are losing money. So you just take people like Kathy Wood, Chamant, and all these guys. Last year they just literally pumped the companies that got no strong fundamentals. Technology wise, probably they are good, but fundamental wise, the business is actually like bleeding money. So these guys are taking a very big hit. We can see it in their portfolio stock price. So we want to give our viewers a systematic way to analyze, look into stocks, understand the fundamentals, and make sure that they are buying financially strong companies. So one of those techniques is discounted free cash flow, the analysis technique. It's one of the most popular one. And then we want to do it for Facebook, right? Yeah.
Correct. So Facebook is a stock that has been in the news of late, and it's crashing hard. I think last week it rebounded about 5 or 6%, but then this week it's been falling very hard again. So the question we are going to ask is, Ruben, what is a good price to buy Facebook at, right? So let's get started.
Sure.
Yeah, so I'm going to share my screen. So we actually made a discounted free cash flow template to show how this DCF method works. You can see my screen all right, can't you?
Yeah, I can see. Yeah.
Wonderful. Okay. Let's just walk our listeners one by one through this. Okay, so the first variable we want to look at is the growth rate for a company, right?
Yes.
So Ruben, what do you think is a good growth rate for Facebook? So
so you can just go to this Yahoo Finance. First we are not we're not trying to go predict any of these things. We just want to take their historical performance and then try to be more conservative when we project that to future. So if you look into their year-over-year quarterly revenue growth, it's decent. It's not 20%. But if you look into the earnings is taking a hit. I just saw that one. It's minus 8.3%. So based on this, you can actually take a decent estimate, like 15%, 20% along the line.
Let's do that.
So yeah.
So the first thing we do is plug in 15% growth rate. And if you notice, guys, we have two growth rates here. The first one is for years 1 to 5. And here the assumption is that they grow at this rate of 15% for the first 5 years, and years 6 to 10, they are a much more mature company, and the business grows at a slightly lower rate. So Ruben, year 6 to 10, what shall we take it as? Is 10% good enough?
Just we keep it for now, and then we can adjust and see later once we have the final value.
Got it. Yeah. So the first 5 years, they grow at 15%. Year 6 to 10, they grow at 10%. Okay. The next variable is the discount rate. So guys, what this means is basically, the simplest explanation is how much return are you expecting from this stock? So 20% is a little bit ambitious, but let's just keep it that way. Ruben, do you agree?
Yeah.
If you look at the typical stock market returns, it's roughly about 10% for the last 10 years. But let's say, you only want to invest in companies which can compound at least a 20% rate. So let's test out what will happen if we plug in 20%. All right. So the next variable is the terminal value. So think of terminal value like this. Now you're the CFO for Facebook, or you're the CEO of Facebook. You want to estimate growth for the next 10 years. But beyond 10 years, you understand that it is very difficult to estimate growth. So what you do is instead you ask yourself the question, 10 years down the line, if I want to sell my business, what kind of multiple of free cash flow will an intelligent investor or a buyer be willing to pay for it? And Facebook is actually a cash printing machine, as we're going to see soon. So I think 20 times free cash flow is a very reasonable multiple. For other businesses like Costco, for example, it's just a retail business, so you can plug in something lower or higher. It is all up to you based on your assumptions. All right. So the next variable, Ruben, do you want to walk us through this?
The 1 year free cash flow is the value that we take from the balance sheet, right?
Absolutely.
So we just go to the balance sheet. You have a lot of platforms out there. Or you just go to their SEC filings, and then you take their either trailing 12 months value, or you can just take the latest one. That's the one that actually tells you.
So I like to use Morningstar, guys. But like Ruben said, you can take it from the SEC filings, or you can also use Yahoo Finance. But let's stick with Morningstar for now, because I'm comfortable with Morningstar. So you go to Morningstar, and up top, you just search for Facebook. That should take you to the Facebook page. And you just click on the right ticker, FB. Okay, so once this loads up, click on financials. And the next step is, once the financials page loads, so free cash flow is always shown in the cash flow statement. So you should click on cash flow. And as you can see here, the last row is cash flow. So let's just take the trailing 12 months value, which in this case is the same as the 2021.
So this is actually in billions.
Yes,
so
good point. Yeah. As you can see here, it's in billion.
40 billion, yeah.
Yes, so you want to make sure that all the values you plug in here are in billions. Good point, Ruben. Thank you. Yeah, so you basically plug in that the number from Morningstar, which is what you've done here. Next, you want to look at the excess capital. In other words, this is how much cash do they hold on their balance sheet right now. So again, you can go to Morningstar, but this time click on the balance sheet, because the cash and cash equivalents are shown on the balance sheet. So as you can see in this row, cash and cash equivalents, that would be, I just want to take the 2021 value, so which is 48 billion. So I took this and I just plugged it here, which is why you see 48 here. Okay, so now that you have this data nailed down, the next step is, the next stage is to start our discounted cash flow calculations. Okay, so Ruben, I've been doing all the talking. So do you want to demonstrate?
Sure. So first we start from year one. Year one is 1 year from now, basically.
Yep.
And then you take the free cash flow,
which is 39 billion.
39, yeah. And then you grow that number with the chosen growth rate for the 1 to 5 years, which is 15%.
Yes.
So which actually gives us the 45 B of free cash flow for the next year. So the same goes, yeah. So for this one, we just actually let the Excel do the trick, from then on for the next 5 years. And after that, I think it will correct itself, right? It will take the other growth rate for the other 5 years. Yeah.
year 6 to 10, right? So as you can see, guys, for the first 1, 2, 3, 4, 5, we have grown this cash flow at 15%, and for years 6 to 10, 6, 7, 8, 9, 10, these 5 years, we've grown it at only 10% because we are assuming that growth decelerates a bit, right?
Yeah.
Now, if you remember, we were talking about the concept of terminal value, and we explained that at the end of year 10, we want to sell the company at 20 times cash flow, free cash flow. That is precisely what we've done here. End of year 10, we are taking the latest free cash flow number and we are multiplying it by 20. So 127 times 20, which yields this number here, right?
2.5 trillion, yeah.
2.5 trillion, exactly. Okay, so now that we have these free cash flows projected out for the next 10 years, what you want to do is you want to discount these back to today, right? To understand what is the value of these cash flow right now.
Yeah, and so basically factoring in the inflation, the money that you have now is worth more than what you will get later. Yeah, that's
exactly.
Yeah.
Yes. And how do you do that? It's very simple. So you take the free cash flow that you calculated. For example, let's look at it for year 1, 45 billion, right? You're asking the question, what is $45 billion worth today?
Yeah.
Right.
It's 37, yeah, based on the numbers.
Yeah. Yes. And how do you do this? So you use this formula. So basically you take the free cash flow that you calculated and you divide that by the discount rate raised to the power of the year.
Yeah.
Okay. So you just do the same thing for all the free cash flow values that we calculated, but you end up with 409. Okay. So now that you have the present value of, and the next step is to basically add all these values up. So, right. So you get 704 billion, which is the present value of all future cash flows.
Yeah.
Right. So now the next step is to understand how much is the equity worth. So Ruben, you want to explain how to calculate that?
Yeah. So, what we are doing is, so now we have a business, and then for that, in the next over a period of 10 years, it's going to give us $400 billion after discounting it, for the inflation based on our discount factor. And after that, what we are doing is, so this is technically like the current value of the business.
704, not 4.
Yeah. So, and then we add with the cash that we have in our hand currently, which is like 48B.
Yeah.
So we add it to that one, and then we subtract the debt from that one. So let's say if you go ahead and buy the business, so you have to pay the debt. So you just pay it out. So and then what is left is the equity. Yeah.
And where do we get debt from? Again,
the same. You can go to the financial statements. Yeah.
Yeah, and so debt is balance sheet. So as you can see, a total debt that is 13.87 billion. So let's just call it 14 billion, round it up.
Yeah.
Okay. Yeah. So like we were discussing, present value is 704 plus 48, 752 minus 14. So you get 738. That's the value of the equity in the business.
Yeah.
So now this assumes no dilution, and share count will just stay the same as it is right now.
Yeah.
So next.
And also the debts. Yeah.
Yep. Exactly. So now we have a value for the entire business, but we want to see what is the value for each share in the business, the value per share basically. So for that, we just take equity and divide by the number of shares outstanding. So again, where do you get the number of shares outstanding? Sorry.
It's basically shares outstanding.
Yes. So you can get it from the balance sheet, but I'm having some trouble finding it in Morningstar. So I'm going to suggest you either look at Yahoo Finance. Where do we see that?
You can try summary. Just go to summary.
Yeah. Yes. Oh yeah. Shares
Yeah,
outstanding.
start functioning over there. 2.3V.
Yeah. So this is under Yahoo Finance statistics tab.
Yeah.
2.31 billion, right? So you just wait. Okay, no worries. You just want to plug that in, and what you get is basically the next step is to divide 738 by 2.31, the value of the equity by the value of the number of shares outstanding. Now, guys, just remember all these values are in billion, so the shares outstanding must also be in billions.
Yeah.
Let's say you're doing a DCF and the company has like 100 million shares. So you just want to divide it by 1 billion to ensure that you have the proper value before you plug it in here.
Yeah.
Don't just put 100 or 50 or whatever it is, right? So now, based on our growth assumptions, we get a value per share of 320.
Yeah.
But now at this point, if you look at the Facebook share price, you can just Google it. Wow, it's dropped so much.
Yeah.
And you just plug that in here. Okay. So as you can see, a fair value for the price for Facebook shares is $320, but the current price is just almost 215. So the shares are trading at a 33% discount. So Ruben, based on this, what is this a buy for you, or what do you think?
Yeah, I mean, it looks financially attractive,
Right.
Yeah, so what it is giving us is the margin of safety, right? It's below the discounted value, so it's a safer bet. So from here the question to ask is what could go wrong from here.
Exactly.
So yeah, so Facebook got WhatsApp, Instagram, and all these apps. It's gonna be used. So the TikTok is another kind of platform for entertainment. So it's just Facebook is going to be the king for some time. Yeah, so and then that will still be the best platform to get your customers. So and then they have a lot of cash in hand, and then they can always do anything surprising. So yeah, just go for it. Yeah.
And I think
Because the valuation is attractive, that's the main reason. Yeah.
absolutely, yeah, especially for a business that generates so much, excess free cash like Facebook.
Yeah.
Yeah. Now, one thing I just want to clarify is, if you ask people, they just say, "Oh, you just buy a business only when it's trading at 50% discount and all that." Yeah, that's a good way to look at it. But you have to calibrate your expectations according to the kind of business. If you kind of wait for a business like Microsoft or Amazon to trade at 50% discount, I would say it's very hard to get such opportunities, except when there is a big crash like 2008.
Yeah.
Yeah. So my feedback is, just keep your expectations reasonable.
Yeah. And then put a decent person offered in cheaper option, discounted option. And then and then just don't go exceed. If it keeps dropping, then you just stick to a limits basically. Yeah.
Yeah.
But
now let's do a fun exercise. Like, we see that the market price is about 215. So we can just try to see, what would the growth rates look like if you were to match the market price.
Yeah, sure.
So let's just plug in 2% and 2%. Maybe 5 and 2. 5 and 5. Yeah, I think that's very close. Right?
Around there.
Oh yeah, perfect. Okay.
Yeah, 6%.
Yeah, so it seems like the market is assuming that this won't grow more than 5% for the next 10 years, which I think is very, very harsh and overly conservative.
Yeah.
Yeah, even though the core products are under threat from TikTok, I don't think it's going to grow at 5% rates.
Yeah. So and also you see, right? So these guys got shitload of cash.
Yeah,
So if you scroll down, they could actually reduce their shares outstanding. Take it to 2.1. Take it to 2, or take it less than $2 billion.
correct.
So eventually, just by pure math, the stock price is gonna like go up
Yeah,
technically.
let's model it out, Ruben. Let's try that. So let's say they spend about 10% of this,
Yeah,
or
2.8 B.
yeah. So the current price is 214, right?
Yeah,
Now, let's say they buy like, or I just make some assumptions. It's no need to be exact. So let's just say they use 8 billion for buybacks, and they reduce like 31 million shares outstanding.
yeah,
So the value per share increases because you'll actually own a larger part of the cash flows as an owner of the business, right? So if you
Yeah.
can discount it, it actually increased more. So
Yeah.
let's say you reduce the share count a little bit more. Well, see, your discount increases.
Yeah.
Yeah. So yeah, that's how it works.
You can see, right, the 730B, while there's only one change. You just took out the 8 billion. But apart from that, there is a significant jump in
Equity value.
the share price. Yeah.
Yeah, yeah.
Even though you reduce the equity value, you use that to buy back, and then your share price has gone up quite significantly.
Absolutely.
So that's
yes. Yeah. Yeah, I mean, we just wanted to show you guys a proper way of valuing businesses. And anything else to add, Ruben?
Yeah, I mean, that's it. So I mean, if you guys want us to do this for any other stock, then you just do let us know in the comment section.
Yeah, it's a lot of fun, like plugging in all these numbers and discussing these growth rates. So we'd love to hear your feedback, and if you want us to value other stocks, let us know in the comments. And yeah, that's all we have for you today. Thank you so much. I hope you had a good time. Have a great day ahead. Signing off,
Thank you.
Ravi, and my co-host Ruben. Take care. Bye.
Bye.